My name's Cliff Hale-Sanders. I'm president of Cerrado Gold. Been with the company since its inception, since 2019 as a private company. It's now obviously public, trades on the TSXV and the OTC market in the US. So today we're going to walk you through the Cerrado Gold story in a relatively quick fashion, but it's a little bit different than most junior mining stories in the sense that we are in production and we have substantial growth opportunities coming from our various assets dotted around the world. So what is Cerrado Gold today? Today we're a steady state producer. We're producing roughly 55,000 ounces of gold per year from our operating Minera Don Nicolas mine located in southern Argentina, and we believe we have significant exploration and expansion potential over the longer term. Based on a 2024 PEA, we are expecting to generate about 50 million of cash flow and 25 million of free cash flow at $2,100 gold, and that was over a 4-year mine life at that time. Obviously, we've consumed about a year and a half of that since then. We've commenced a significant exploration program in the second half of 2025, looking to grow that resource base significantly and add different types of ore to the production process. We have both Heap, Leach, and CIL plants. We've also started a modest underground development program, really for longer-term exploration activities, but it will expect to contribute to production in 2025 and 2026. Over the medium and longer term, we're looking to develop the Lagoa Salgada project in Portugal. This is a significant VMS project, very heavily skewed towards gold and silver. A construction decision is expected in the early part of 2026, and we're now at the final phases of the permitting process as we go forward. Again, we believe this has the potential to be a significant and continually expanding project, similar to other projects in the Iberian Pyrite Belt, such as Neves-Corvo and Aguas Teñidas. Over the long term, we have further critical minerals optionality. We're developing the Mont Sorcier high-grade iron project, producing 67% iron concentrate, which is suitable for the DRI grade steel production process and the so-called green steel transition, making this a very attractive product for the longer term. We expect to complete a bankable feasibility study in Q1 2026, maybe into Q2. We're well funded to deliver on this growth profile. As at the end of June, plus some cash we received from a Hochschild's prepayment, we have about 14.5 million of cash. We're expecting cash to continue to grow throughout the second half of 2025. Obviously, at today's gold prices, it should be significant as we continue to invest in our other projects and continue to strengthen the balance sheet. So we're well funded to develop these high value projects and continue to minimize shareholder dilution as we continue to grow. Looking at what we've done over the last several years, obviously we acquired the mine in Argentina in 2019, just as COVID hit. So it took a year or so to turn it around. Was very much an underperforming asset. And since then, over the last 4 years, we'll be well above 50,000 ounces of production. And currently in 2025, we're targeting a guidance of 55,000 ounces. In the medium term, with the development of Lagoa Salgada, we'll continue to add precious metals exposure. Depending on what prices you want to use, if you use the feasibility study prices, we'd be looking at 62% of our revenue streams coming from precious metals. And at spot prices, especially for gold and silver, we'd be looking at 81% still exposure to precious metals. So despite having copper, zinc, and lead production, we will still very much be exposed to precious metals. Longer term, obviously, we could add the iron development opportunity as well. Looking at this on a value proposition, the cash we have currently, the free cash flow we're generating from Argentina, and looking at the 43-101 reports value of the project in Portugal with an NPV of 146 million, and the Quebec project of Mont Sorcier with a 1.6 billion longer-term optionality, we see ourselves, despite the recent share price performance, very much remaining well undervalued. Another way to look at the value proposition as we see it is really building on these assets as building blocks. So you can look at it on a simple basis of gold equivalent production. We're currently targeting 55,000 ounces. With the addition of Portugal, we'll be just under 100,000 ounces, and longer term, if we develop Mont Sorcier, well in excess of 300,000 ounces of gold equivalent production. Another way to look at it is using, again, the independent report valuations. Obviously, at today's metal prices, these numbers would be greater. MDN was worth 111 million at $2,100 gold. You add that to the 147 million for Lagoa Salgada, you get 260 million US, and longer term, you can see a value of 1.8 billion based on the NPVs generated from these reports. So again, a lot of things have to happen to bring that value forward, but we see the potential here for significant value creation. Another way of looking at those same numbers is really looking at it from an EBITDA perspective. MDN is expected to generate $44 million at $2,100 gold of EBITDA. Obviously today that would be higher. Combine that with Lagoa Salgada, you're looking at $112 million US per annum of EBITDA. And longer term, with the development of Mont Sorcier post 2030, you're looking at just under $500 million potential EBITDA. Now, clearly, you could put a 5 or 6 times multiple on that, and you could have a substantial company of multiple billions of value. We believe we can use the cash flow from each asset to support the development of the next asset, thereby minimizing the need to come to the market for significant equity dilution for shareholders. So what's driving this value proposition? Obviously, in the short term, it's the continued gold production from Minera Don Nicolas. And as I said, we're based on $2,100 gold. We would be expecting $25 million of free cash flow. Obviously, that's going to be significantly higher than that, and that cash will be used to fund the development of the other projects and continued investment in Minera Don Nicolas. So right now we're using our heap leach and underground production. We have roughly 3 years of mine life, a little bit under, based on our current resources. We're targeting a significant exploration program that has started recently, and that'll continue throughout 2026. And as I'll demonstrate, other mines in the area, once they've gone through a significant exploration program, that is when they've been able to add substantial resources. So we think we have a high potential to add to that. We're also starting our underground development, which really longer term will be for exploration. At Lagoa Salgada, we're just going to go through the process of completing an optimized feasibility study in the latter part of 2025. We're already submitted our permits. We have a few things to resubmit there as requested by the various permitting agencies. And we expect to be getting our construction permit by Q2 of 2026, start construction in the second half of 26, and be in production in early 2028. Mont Sorcier is a little bit longer term proposition. The bankable feasibility study should be done in the first half of 2026. Submit the environmental assessment in Q3 of 26. Complete the project finance 28, and production is possible by the early part of 2030. So this is a relatively, from the mining business, a relatively rapid expansion profile. Again, we believe that we're well positioned to deliver on this using our asset bases to support the next level of growth. Going into a little bit more detail on the individual assets themselves, at Minera Don Nicolas is located in the southern part of Argentina in the Santa Cruz province. It's in what's called the Cerrado Massif, which is where all the large mines currently are operating in Argentina are located, such as Cerro Negro from Newmont, the Hochschild's McEwen mine, San Jose, Cerro Moro owned by Pan American, and Cerro Vanguardia owned by AngloGold. We currently have 330,000 hectares of land, so the largest land position outside of the government in the district. As I've said, we're expecting steady state production per year through to 2028, and we're looking to grow the current mineral resource from its current level through exploration. And right now, historically, because of COVID, lack of capital, exploration have been focused solely on near mine targets. Now we're starting a much more district scale sort of exploration, which we believe has the potential to replicate what we've seen at other mines in the district. And when I say other mines in the district, if you look at Cerro Vanguardia, Cerro Negro, and Cerro Moro, every time they have undertaken a significant exploration program, you have seen a step change in their resources. And we're not trying to say we're going to do anything better or different than anyone else. We're just going to follow the same trend that we've seen throughout the district. We just haven't had the opportunity at this time to do it. We are, again, by having a heap leach operation and a CIL plant, well positioned, irrespective of finding low-grade ore or high-grade ore, to be in a position to process that material. Again, this is the same sort of structure that you see at Cerro Vanguardia, Cerro Moro, and to a lesser degree at Cerro Negro. So again, following a well-trodden path to grow production and mine life. Operationally, the team has done a tremendous job of turning the mine around from a significantly underperforming asset when we acquired it. Despite the restrictions that were put on during the COVID era, they were able to significantly improve production, continue to keep costs down, despite the inflation issues that are hitting Argentina quite hard, and will remain right in the cost structure of the current landscape for Argentina, and we expect to remain there at these production levels. Looking a little bit in hindsight, the PEA that was produced in 2024, just to say it's not just us talking about it. This is the independent analysis done at that time. We had a mine life of 5 years and an NPV of 111 million at $2,100 gold. So obviously that would be significantly more attractive. But what that was based off was really our Heap Leach development project that was completed in 2023, where we spent all the capital. That's the debt that's on the balance sheet. We're building the Heap Leach facility. That cost about 35 million. That is now being, that debt is now being paid off. That's really going to be a very steady state producer as we go forward. In the background, we still have the CIL plant, which is now processing low grade ore stockpiles and ready to position for the higher grade material coming from underground. So as I said, exploration now is focused on more regional targets and underground, and we expect that to have a significant potential to grow over the next sort of 12 to 18 months. And where are we targeting this initial exploration? When you look at the underground targets, it's right below our mined out pit. So we were mining at the bottom of the Paloma pit at 8 to 10 grams per ton. So we're looking at just going into the existing ore body by ramping down. We'll be getting some material as we ramp down through the portals, but it will probably get to the real juice, the high grade material in the latter part of Q4, and that'll see a significant uptick in production as we access that zone. But again, this is also going to provide a much better platform to continue to follow the resource and the ore vein, because on surface there's essentially no visible indications of the ore deposits. It's a very rough terrain from that perspective. So we expect this one to be, in production on a modest scale currently, but quickly ramp up over the coming months. On the more regional basis, we have a number of targets up and down what we call the Paloma trend. It's over 10 kilometers, and really we just need an opportunity to drill it off, and that is something that over the last couple of years we have not had an opportunity to do in any systematic way. So we have a plethora of targets, and this is just in the north. We have a number of targets throughout the region to continue to explore. So I think this is just a matter of time as opposed to anything else. These are just some of the targets we're doing, and these are not blind targets. There is the odd hole that was done by the previous owners that we're following up on, such as at Sulfuro East, where they had 0.7 of a meter at over 15 grams and 3 meters at just under 6 grams. So again, these are targets to follow up and define to a greater level of detail before we bring them into the production profile. But we have significant confidence in bringing them forward. When you look at the rest of the land package of the 33,000 hectares to the south, we have the Chispas deposit, which is a long strike from the Cerro Moro deposit. Again, hasn't been drilled off. Significant opportunities there. And in and around the Martinetas pit, which is the previous mine zone of low-grade material, there's a plethora of opportunities now to follow up. And obviously with the gold price where it is, it does change the dynamics of what the previous owners and operators were looking for prior to our arrival. Stepping across the water to Europe, the Lagoa Salgada VMS project. This is quite a near-term project in terms of mining development. We currently own 80% of the project. The other 20% is held by our joint venture partner. This is going to add substantial gold and silver exposure at spot metal prices. 42% of the revenue would be coming from gold and silver, but the rest from zinc, copper, and a little bit from tin going forward. It is expected to be an extremely low-cost mine based on zinc equivalent production, especially in the first 5 years. And at current prices, these numbers would be even more attractive. We're currently doing an optimized feasibility study. The full feasibility study was completed in 2024, and we just have the opportunity here to improve on some of the key dynamics of that as we waited for the permitting process and get a construction decision probably in Q1 of 2026. We're well funded to deliver on this to construction, and then as we go forward to construction, we are working with the UK Export Credit Agency and Banco Santander to support up to 70% of the upfront capital required for the project. We have a stream with Sprott that has supported development to date, and they've indicated a desire to expand that stream. We'll look at that in the context of the market, and we're also looking at potential off-takers that have a prepayment from that process. So combined with cash being generated from Minera Don Nicolas, we expect equity dilution, if any, for this project to be modest. Just looking at some of the numbers that were put forward from the previous feasibility study, we had about 14 million tons in the proven and probable category at about 9.5% zinc equivalent, and another 18 million tons or so in the measured and indicated. So lots of room to grow this deposit with a little bit more drilling. But that being said, the initial feasibility study had an NPV of 147 million and an IRR of 39%. We're looking to improve on those numbers with the optimized feasibility study. Similarly, EBITDA was 75 million per year for the first 5 years of operations before we ended up in slightly lower grade, but I think we'll see that improved as well going forward. Where are we now in the process? Right now, we're in the process of we're at the final stages of completing the updated feasibility study, and we'll talk about some of the enhancements we see there. We're in the final phases of submitting the required documentation for the environmental permit. We expect that to be in place in Q1 of next year. And then the recape process, which is a Portuguese, essentially detailed engineering and construction approval process, where you get down to the brass tacks of what you're actually building. We expect that to be completed by the end of Q2. Project financing is working in parallel in the background in preparation for all of these various items to be completed. And then, as I said, construction is relatively straightforward. It takes about 18 months, in our opinion, for first ore, and then continue to ramp up thereafter. So in the optimized feasibility study, what are we trying to do here? We saw the opportunity to improve on that previous study by improving the metallurgical performance of the various concentrates, to improve the grade of the concentrates themselves, improve the recoverability of the metals, and decrease the pellet elements that are in the material, as is again prevalent in the Iberian Pyrite Belt. So to date, all the results continue to see significant improvements, and that itself is going to drive significant improvements, in our opinion, in the upcoming NPV of the project. The resources themselves are expected to improve slightly just because of the higher metal prices that we're seeing, and obviously the higher value per ton that's being driven by improved metallurgy is bringing more of the resources into the proven and probable reserve category. Capital expectations are to be relatively similar, maybe a little bit lower, but that's going to just be offset by improved operations. We're also just simplifying the entire process of construction, flow sheet, and various trade-offs, such as using dry stack tailings in that region. So we expect to see a significant improvement in the NPV. We're also looking at, should it be a slightly bigger operation? In the initial study, we looked at 1.2 million tons per annum throughput. Maybe it should be 1.4, 1.5, and we'll look at those scenarios in the final phases of the updated feasibility study. But again, one of the things we really like about this asset is not just what the current feasibility study is telling us. Lagoa Salgada, right now, the ore deposits in the north and south zone are relatively shallow, only down about 300 and 350 meters, which when you look at the Aguas Tenidas deposit acquired by Sandfire in 2023 for 1.8 billion, or Boliden's recent acquisition of the Neves Corvo asset for about the same price, these are significantly deeper in depth, and as you see, have multiple additional pods of resources. So we believe, as we continue to move forward, the potential to outline additional ore deposits in the region is very, very high. Again, it's just been constrained by capital since we've acquired this asset. We're also working with the European Union on a project called Undercover, which is a deep penetrating radar geophysical process beyond my technical skills, to be honest, looking at depth to see what the opportunities hold. We expect to get those results in the near future. Looking into Canada, the Mont Sorcier project on that longer term optionality going forward. Bulk commodities is really about logistics. And one of the key benefits for Mont Sorcier is the railway and the port facilities are already in place. We have 370 kilometers of railway from Saguenay to the town of Chibougamau, which is where Mont Sorcier is, and the port of Saguenay, which is a federally owned port, which really doesn't have any major customers at this point in time. And we see the Quebec and federal governments looking to open up the northern part of Quebec for further longer-term resource development going forward. So this is going to significantly improve the capital requirements going forward, and also significantly speed up the process of development. We did do a PEA back in 2022, looking at a slightly inferior project. We were looking at 65% grade iron ore at that time from the concentrate production. It had an upfront capital requirement of about 575 million. We are seeing some inflation on these prices going forward, But the key benefit we saw at that time was an IRR of 43% and an NPV of 1.6 billion. So we're now at the point where we've done additional metallurgical test work to demonstrate the ability to produce the high purity 67% DRI grade iron concentrate with very low silica and aluminum, making it a very desirable product for the market going forward, and especially for the so-called green steel transition. So we now expect to deliver this product into Europe or the Middle East, as opposed to sending it to China, which was the original assumption, because that's the most expensive. The excellent infrastructure requirements of the rail, the port, the hydroelectricity in the region, again, is going to significantly decrease the upfront capital requirements relative to other similar sized projects around the world. And again, similar to what we're seeing at Lagoa Salgada, we already have interest and support from the UK Export Credit Agency and TD Bank to fund up to 70% of the upfront capital needs, despite it still being several years away from a funding decision. So with the 67% DRI grade material, not only is it the product the market desires, within the iron ore business, it's a 2 billion ton per year industry. We're only going to be producing 5 million tons per year, so we're a very small piece of that puzzle. The industry itself may be growing at 1 to 2% per year, but the higher grade component of the 67% grade type material is growing at around 10%. So every ton you can produce of this high grade material will very quickly replace lower grade materials, and we're seeing a significant premium for the premium price for this product, because it significantly improves the environmental footprint of the steelmaking process going forward. We believe we can move this project forward in a relatively stable timeline and be in production by Q1 of 2030, all things going well. It is a sort of a medium-term project, and we'll look to continue to outline that as we go forward. But again, despite us being a junior company, this is not a exploration play. We've already outlined 1.2 billion tons of resources. The PEA for the 20-year mine life that was outlined only consumes about 30% of this material. So there's significant room for future expansions to double the size of the facility, depending on what the market will bear going forward. So we see opportunities to grow this asset over time to significantly increase the value potential that we see here. As I said at the beginning, we believe we're well funded to deliver this growth profile without significant equity dilution. The cash balances, as I said, based at Q2 with the additional payment from Hochschild we received of 8.9 million earlier this quarter, we have about 14.5 million, and we're obviously expecting cash to continue to grow. That being said, we are continuing to fund our various development assets at both Lagoa and Mont Sorcier, and continue to pay down debt to deleverage the balance sheet. So we still have additional cash to be received from various asset sales. We have 5 million left to be received from Hochschild by March 2027, and we have a potential 10 million to be received from Cerrado, who've optioned off some property we had in Argentina that was of no non-core to us, and we expect that to be by 2028 or earlier, assuming they exercise that option. When you look at the project financing that we are looking at for the various projects at Lagoa and Mont Sorcier, this seems to be the way the mining industry at the smaller and mid-cap process size companies are going towards. It is a UK export credit agency supported funding, which allows for longer term, longer duration debt at very attractive interest rates relative to other, straight mining bank financing, assuming it's even available. So we're continuing to move that forward. We're continuing to look at augmenting project financing with additional streams, if that makes sense, or new capital if the equity markets are more attractive from a value potential for shareholders. So we're also looking at a variety of different offtake partners. So again, this is very well supported going forward to deliver on these projects. Looking at the team, we've done it before. And this is what I think people, really need to take heed of, is the team has been together on and off for about 20 years in various capacities. The first real, success as a group was at Desert Sun Mining, where they acquired the Jacobina mine from Yamana. Sorry, not from Yam, from Anglo American, turned that around, and within 4 years sold it to Yamana for just under $600 million. Again, at Largo Resources, from the very early stage exploration, so essentially zero market cap, all the way through resource development, feasibility, construction, and then operations to a peak market cap of 2.5 billion before the team moved on. And essentially for a couple of years, we worked at Sierra Metals, repositioned that company, went from 200 million market cap to over 600 million before we essentially created, as a private company, Cerrado Gold and various other vehicles. So the team has significant experience in delivering these assets, and we believe that combined with the access to capital will make this proposition very attractive. The current capital structure is very clean in our opinion. 134 million shares outstanding, 143 fully diluted. Management and the board own about 11%. We're really very much a free float company at the moment. No material institutions. Obviously, 2024 was a repositioning and transition year, and 2025 is really the year that we've come back to the table and have been a very exciting story going forward. So just to sum up, the investment highlights of Cerrado Gold as we are now is a steady state gold producer with significant room to continue to grow that through exploration. So while on paper we may only have 2.5 years of mine life, based on what we see on the ground, we think this exploration program is going to bear some significant fruit and very quickly make that mine life 5 to 6 years, and we'll continue to explore thereafter. In the medium term, we expect the Lagoa Salgada project to bring forward additional production in Europe of obviously precious metals, a little bit of copper, zinc, and tin. And that's going to be the next step, the next building block of this process. Funding will obviously, as I said, be delivered from our existing cash flows and obviously the support of the UK Export Credit Agency. Longer term is the optionality provided by Mont Sorcier, and we believe the best way to unlock that value is to complete the feasibility study and demonstrate the value that is there, continue to progress the environmental requirements, and continue to show that value opportunity with that asset. And again, unlike many junior companies, we don't expect to have to come back to the market every 6 months to refill the cash. We're well positioned with the cash balance today, cash being generated to support the development opportunities we see as it stands today. And with that, that's the end of the major presentation.
Cliff, could you tell us about yourself and your career?
Sure. Well, simplistically, the last 10 years I've been working with the team here at Cerrado Gold and Ascendant Resources in various capacities. But for the 22 years or so prior to that, I was a sell-side research analyst, worked at various brokerage houses and banks here in Canada, so focused solely on mining assets. So seen a lot of mining assets around the world, very quick to understand their stages of development and how they're being run.
That's short and concise. So how many shares do you hold of Cerrado, and how important is it to your own network?
It's quite important. As I said, management team own about 11%. I have several million shares myself, so it's from that perspective very significant to the overall net worth. The idea is to continue to grow that, so it's more significant.
I guess, could you just quickly walk us through how Cerrado got started and how you essentially got to where you are today and with all acquisitions?
Well, Cerrado got started, as I said, the team has been together on and off for 20 years. So they all, on the operating side, they kind of met at Desert Sun. They moved to Largo together to develop that. And then as Cerrado Gold started to become a real entity, we started pulling people back in. Now, Cerrado started as a private company developing the Monte do Carmo asset in Brazil. Obviously, the team has significant exposure to Brazil with Jacobina and Largo. And we progressed that from 0 ounces to 1 million ounces. And that was really the basis of the company at the time. We got the opportunity through various contacts we have to buy Minera Don Nicolas. So we put that together with the Monte do Carmo, and we had a gold vehicle, which we then went public with in 2021. So that was how Cerrado was born at that time. And since then, we brought the other pieces together in terms of M&A. We brought in the Mont Sorcier asset and the Lagoa Salgada assets. These were kind of companies within the umbrella of the management team and the board, which at various times just created the opportunity to get it under one vehicle to streamline the management approach. Now, longer term, we're here to make money, not just hold on to assets. At the right time, we could look to sell things if that's the right approach. But we do believe we have the capacity to build and operate.
So then, essentially, you had $14.5 million US dollars in cash at the end of Q2. You received $8.75 million from Hochschild, and you're cash flow positive. So what's the working capital position, and how much debt do you have?
The debt right now is probably about 15, 17 million. Now, it's a bit unique because most of that debt is in Argentina. It's all going to be short-term paper, so it's all one-year paper. So it makes our working capital always look a little bit high on the negative side. But that is easily refinanced in the domestic market. It's a very unique place at the moment from a capital perspective. Argentina is just reemerging from its various capital controls and getting much more attractive from an investment point of view. But it has meant that access to capital has been relatively straightforward, and so that debt is on the balance sheet. The other debt that's there is typical payables, working capital positions that we would expect to be at an operating mining company.
Okay, and what's the interest on debt?
It varies, but I would say it's high single digits. Just as a bit of background, when Argentina went through its significant inflationary bubble at the end of 2023, which was one of the issues that put us in the need to sell our asset, Monte de Carmo, to Hochschild, we're seeing 300% inflation. And at that time, you could actually borrow money with negative interest rates. So it was more about preservation of capital than interest. So again, it's a unique marketplace.
And what's the quarterly G&A, and how do you expect that to change going forward?
Quarterly G&A is probably about one and a quarter million. And to be honest, I don't expect it to change much. We will be having to augment the teams at the project levels to build out, but obviously that'll be project-specific development teams, construction teams, and whatnot. But I believe at the corporate level, we're pretty much set with all key positions filled at this point in time. So I don't expect significant changes there.
How much cash do you have left to receive from Hochschild, and where will you receive that?
Hochschild, we have 5 million left up until March 2027. We could look to discuss with them accelerating that if we desired, but which is what we did with the prior 10 million. At this point in time, there's no need. And the other 10 million is the option payment from Cerrado Vanguardia. They have a further 2 years, but we believe, based on what we hear, that there's potential that they exercise early, but there's no guarantees of that, obviously.
What happens if they exercise early?
We'll get 10 million.
Okay, so you have 10 million, and you have 5 that for sure will come.
Yes.
In 2027, and then you have the possibility to get 10 million. When do you think you will know if they exercise early?
I think that depends on their exploration success. It was a piece of property that was well too far away from our core asset, and it's right next to their operating mine, so it was always going to be feeding their mill.
Well, that's a good bonus. When is the deadline on the joint or the earning?
They have about approximately 2 years left.
And how do you handle your cash management? And can you move money out of Argentina without incurring a haircut?
You can now. They changed the rules. So any funds you make in 2025 and beyond, post audit, so there's audited numbers from the year end, you can repatriate that money to your home country without any haircut. Now, in the past, you've had to use different vehicles and structures to minimize the haircut that you'd be required to take. But you could always get your money out. It was a question of how much it might cost you.
So now essentially do you pay withholding taxes, or how much does it cost if you're going to move $1 out of Argentina?
It depends on the day. Right now, the exchange rate, because of the various, they're going through an election cycle, are up and down quite a bit. You can do what they call the blue dollar swap. So you buy a bond in Argentina, then you sell it in New York, and that haircut could be up to 20% if you needed to. You can also take money out of Argentina, and you don't have to send it back for 180 days.
And you have a hedging program in place. Can you explain that, and are you going to extend it when it terminates in December?
I think we'll look at that in December. We'll look at that. Obviously, we've been using the hedging program more because of what we were coming out of 2024. Obviously, 2024 was a transition year, waiting for the Hochschild monies to come in and really reposition the balance sheet. And that's what the hedges were really put in place for, was to secure that cash flow, to help us delever the balance sheet and really position the company for the medium to longer term. So it's not something that we wanted to stick with, but we thought at the time it seemed prudent to secure the cash flow to really improve the balance sheet, and they stabilized the company.
Would you look to hedge through physical hedging, or would you like to hedge through collars?
We do costless collars at this point in time.
Minera Don Nicolas, what royalties and metal streams do you have on your land package?
Well, there's a variety of government royalties, typical production-based royalties of 2.5%. We have a 2% NSR payable to Royal Gold, and Sprott Resources has a 6.25% stream, which was used to fund the acquisition. Once we've delivered 29,000 ounces to Sprott, we have the right to buy back or reduce that amount, that stream to 2.5%.
And yeah, I guess you will buy it back, buy that down.
Probably.
When was the buyback due? It was 10,000 ounces. Okay, yeah.
Based on the
And where are you now with that delivery?
We're probably halfway.
Oh, by the way, are there any local communities, any communities on your land package?
No, it's a very remote location. It's kind of like in a large gravel desert. The closest real population is probably 100 kilometers away.
And you're guiding 55 to 60,000 ounces, gold equivalent ounces this year. How are you tracking guidance?
I would say we're tracking towards the low end of that range. The key driver of that will be the rate of underground development. As we continue to open up the underground, that's supposed to deliver significant high-grade material towards the end of this year. So that's, as you know, you're talking about the biggest risk. It wouldn't derail guidance, but it could be, that's the real driver at the end, is really a big Q4.
So how much of the gold equivalent ounces are gold and how much are silver?
It's probably 95% gold, very little silver, which is unlike Cerro Moro, which is probably 75% silver.
So is it fair to assume then, so Q4 will be the big step up in production, also, cost will behave accordingly, and then Q3 will be a slight improvement to Q2?
I think that's a fair statement. Now, Q4 will be a good step up in production, but the underground will go kind of in waves from the grade profile as we continue the underground development. So it's not necessarily going to be steady state at the level that we're going to see in Q4.
Are you saying that that you'll see higher or lower grades?
Well, it goes through phases based on the mine plan of high grade and low grade. We know in Q4 here we're supposed to go through a high grade sequence, and then Q1 and Q2 it's slightly lower grade. So if people are looking for what would be a reasonable guidance going forward, I would say something in that 55 to 60 range, steady state would be a conservative outlook.
So conservatively, you will produce probably slightly more, a little bit more than next year than this year.
Yeah, that's a good benchmark to have.
Could you also talk about, before we talk more about the underground expansion of underground, start of underground mining, you have upgraded the crushing circuit, or you are doing that, and you're also installing an agglomerator. How will that impact production and recovery rates at the heap leach?
Well, a lot of this is for, in the heap leach, we go through oxide, transition, and primary. And as we get more primary material, we want to crush it finer to get better recoveries. It is higher grade, but the recoveries are lower. But as we crush it finer, we get better recoveries. But it also means in that part of Argentina, there's a lot of wind. So it'll be very fine and blow all over the place. So by using the agglomerator, we'll minimize the fines, the dust. But on the heap leach, we'll also add the more appropriate size for heap leaching, so you don't get channeling through the fines.
When do you think we'll see the full effect of these improvements?
From the outside world, you probably will see it by steady state production. You won't see peaks and valleys anymore. It'll be more steady state because oxide material recovers better through the heap leach than primary. But as we go deeper in the pit, we'll get more and more primary material. So it's really about keeping the production level steady going forward.
Well, what will be the steady state production from Q4 and onwards?
I think to be safe, 3,500 to 4,000 ounces a month from heap leach, and then you'd augment that with production from underground and continuing processing of the low grade stockpiles.
And do you expect, if we talk, so obviously you will have a high grade zone in the underground mine from in Q4, in Q3. I mean, have you reached in ore now? Will we see any impact on Q3?
You'll see a modest impact. The real volume starts coming in Q4. So Q3 has really been a development phase. We're getting the various underground access points open. And as we go through those, when we intersect part of the ore body, yes, we'll process that. But currently the development is more in waste as opposed to ore. And then obviously in Q4, we start opening up the stopes.
What will be the split going forward in terms of sort of ore from underground and stockpiles?
It's probably going to be 75% from stockpiles and 25% from underground. Now, the underground ore right now is really going to augment the stockpiles. Stockpiles are about 0.8 grams per ton. The underground ore could be anywhere from 4 to 6 grams per ton. So every gram per ton we can increase the throughput of the CIL plant is equivalent to about 1,000 ounces.
And how much stockpiles do you have? I mean, how long can you have, what's the mine life for the stockpiles?
It's about 2 years, a little bit under 2 years. So which kind of matches the current underground. As I said, the key thing for underground is, yes, it's going to be nice. It's going to be contributing to production. but really is to act as an exploration platform to follow the ore body. We know it, from the open pit, we know where the ore body is, but it gets a little bit more complicated underground. It's not an area that is easy for us to get the right angle of drilling from surface. So by following the ore deposit underground, we believe the potential is much higher. We can also go laterally to, we have what we call the Paloma area, which is on the Sulfuro vein. We're looking at Sulfuro East, the Rene and Princesa vein. They're all parallel structures to each other. So looking at them from underground should be much quicker and easier with the shorter drill spacings required to grow that resource.
And the grade of the stockpiles is one little over. What's the grade of the stockpiles?
I'd say about 0.8 grams.
0.8 grams. Okay. And how do you think the all-in sustaining cost will vary then in Q3 and Q4?
Well, the thing about all-in sustaining costs at Minera Don Nicolas is really about production. The costs themselves in millions of dollars not going to change materially. It's a very remote site. A lot of the costs, irrespective of the amount of material you put through the mill or on the heap leach, you have to continue to put the same amount of solution, crushing circuits, and what have you. So if you have 10,000 ounces of production, you can have a certain all-in sustaining cost. And if you have 15,000 ounces of production, you can do the math. You're going to see a significant decrease in the all-in sustaining cost. I think our guidance of 15 to 1,700 is a good range to look at going forward. The issue that continues to be something we have to try to manage is the inflation within Argentina, primarily related to labor costs.
So essentially, going into next year, do you have any expectation on all-in sustaining costs, ballpark?
As I said, the 15 to 1,700 is going to be kind of where we think we'll settle down.
Do you have any significant non-sustaining capital expenditures planned for next year? If we exclude any exploration success where you go ahead and develop anything?
Yeah, well, excluding, as you said, that any exploration success, which we accelerate, the only key capital items that we have, and they're really for sustaining purposes, we have to do a modest raise of the dam wall for the tailings facility and continuously expand the heap leach pad as we go forward. But that's really sustaining capital. We've already reinvested in the fleet, so we've got a fairly new fleet over the last year as part of the spending programs that we have had. So we're very ideally positioned with minimal sustaining costs going forward, barring success.
And what is included in your all-in sustaining cost calculation, and what is not?
The only thing that's really not included at this point in time would be things like the underground development. Everything else is pretty much sustaining capital at this point.
Oh, I meant overall, like you have taxes. I mean, do you include royalties,
in there
corporate G&A?
The royalties would be in there. The project, the company Minera Don Nicolas level G&A would be in there. Obviously, the operating costs of the mill and the heap leach, tailings facilities, the sustaining capital that is not expansion capital, which would be underground. So things this year that we've had for sustaining capital would be things like the agglomerator, the improvement in the crushing circuit. Again, those will not be repeating in 2026.
So what do you perceive to be the biggest risk that could potentially negatively impact production and costs?
Production is pretty secure at this point in time, in my opinion. The heap leach pad now up and running. It's, as long as we keep irrigating it, we'll continue to get the gold out. So I think operationally the risks are relatively modest. The real risk is extending the mine life. Right now, as I said, we have 2.5 years. We've seen tremendous success of the other operations in the district from an exploration program to materially extend the mine life. Obviously, we have to deliver on that to secure that mine life extension. We're very confident, but we obviously have to do it first.
So right now you have 2.5 years of mine life left?
Yeah.
Okay, so essentially, and is that both for open pit and underground, or is the open pit, does it have a longer life?
No, it's about the same. Give or take a month or two. But
so then, what is the objectives? What are you targeting with your 20,000 meters so far?
We want to outline a resource that we can quickly bring into production to extend our mine life to that 5 to 6 year range, and then we would expect to continue to try to maintain that 5 to 6 year mine life. Again, very similar to what we see at Cerro Moro and Cerro Vanguardia. They're both on paper down to 2 to 3 years as well. It seems to be a consistent theme in Argentina, and then they all go through a series of exploration. Obviously, these gold prices are allowing for larger exploration programs to take place. Unfortunately, I was just going to add, unfortunately, when we acquired Minera Don Nicolas in those first 2.5 to almost 3 years, the one area we couldn't really undertake any exploration of substance due to the restrictions in Argentina. We just couldn't have the people on site to allow for exploration. And then obviously gold prices were not as robust, so the capital was more constrained. So the one area that has suffered over the last several years has been a more meaningful exploration program that is not more about just near mine. So now we're able to do a much more substantial exploration program.
I mean, you're targeting underground. Are you targeting potential satellite pits too for the open pit material?
We're looking at all types of material. In the past, the previous operator were strictly high-grade open pits. We're comfortable going underground. We're now comfortable developing a heap leach facility. The previous operator was not. If we get high grade, we can put it through the mill. The interesting thing for us is we have all the infrastructure in place to produce whatever type of ore we find. If it's high grade, we can put it through the mill. Obviously, as I said, every gram per ton that goes to the mill is 1,000 ounces. So if we were able to put 5,000 ounces through the mill, 5 gram per ton material through the mill, we could easily see the mill producing 50 to 60,000 ounces by itself and still have the heap leach producing 40 to 50,000 ounces. So the key driver here is the more high grade material we can find, we can very quickly ramp up production.
How's permitting here if you find something?
On our land package, it's very straightforward, given that we already have the bulk of the permits involved. You do have to get minor permits for like when we went underground, but it was not a substantial process, given we're in a ring fence mining area already.
How should you be thinking in terms of receiving assay results and the timing of them?
Yeah, we're not going to release them one by one unless it's like a banner drill result. This area is quite difficult to drill and firm up a resource. You can easily get one good drill hole, but the question is following it up. So we expect to release it in batches. I'll probably put some out sometime during Q4 and then Q1 on that basis. Just because we found in the past, based on the exploration that has been done, until you have several drill holes, you're not sure if you actually have a resource, but you could have some very spectacular drill results. We don't want to be misleading.
But it looks like when I look at your targets, you got Reina Princessa vein, you got the Sulfur East vein. It looks like all of them are conceptual underground targets. Do you have any conceptual open pit target?
Yeah, we have. There's a few more in what we call the Paul Andrea district. Right now, we only have one drill rig. We're probably going to look to expand on that going forward. Now that we're getting a little bit more comfort under our belt, but we'll have to look at that as time passes. But I think that'll be the key driver. Things like that. There are a few other targets. It's a question of what we can drill quickly.
And what would you like to see in terms of grade and scale, both for open pit and for underground, to quickly move to resource delineation, development work, fast track it essentially?
Well, obviously, the higher the grade, it goes to the mill. I know it doesn't quite show well on that map, but the land package has 330,000 hectares. It's very large. So right now we have three distinct operating areas. We've got the heap leach, we've got the underground, and then we have the Martinettas where the plant is. They're each about half an hour apart, so it's quite a fair bit of distance. So again, it depends on where it is and what type of ore it is. If we find low-grade material near Martinettas, we'd probably just make a new heap leach facility down south. High-grade ore goes through the mill. And it really, as I said, we're not too fussed on that basis. It really is a question of logistics than just doing the math on which is the best processing route for it.
Is hauling cost, could that be an issue here?
No, it's really about the volume of material you can haul.
And is there any possibility, so the current open pit, could that be expanded, or is that sort of...
No, the current open pit, which is for heap leach, maybe a little bit of these sort of gold prices if they hang around. But obviously now we're looking for additional similar types of heap leach material to continue to augment that as we look for high grade. Where our initial high grade target is where the high grade was before, which was the Paloma area. When we ceased mining that open pit, we were, as I said, mining at the bottom, 8 to 10 grams per ton. And then we were blending that with material from the Martinettas area, which is probably running at about 2 grams per ton. So it's just a function of getting that grade through the mill.
And could tailing stores, capacity become an issue in the future?
As I said, we're going to do a slight raise, and then we'll start doing a second tailings facility in 2026. It's really not going to. If you could see the area, it's low-lying, rolling hills. That's really not an issue. And as you mentioned, there's no communities in the area, so it's quite quick and quite easy to do.
Let's move to your mining project in Portugal, Lagoa Salgada. You acquired Lagoa earlier this year. Could you explain the deal terms, the price you paid, and the rationale for the transaction, essentially?
Well, the rationale was this was an asset that the management and the board, there was a fair amount of overlap. We understood the asset very well. We understood the value proposition. But at that point in time, the market was not looking towards small cap stories. It wasn't very attractive from that point of view. So they essentially were capital constrained. We saw an opportunity at Cerrado to bring things together at reasonable valuations on both sides from a relative standpoint. So we brought them together in one into one vehicle, and now we're looking to grow that vehicle. So at the time, I think it was, don't hold me to this, I think it was 6.8 shares to one on that basis, which represented about 20% of the combined company.
Could you explain the ownership structure of the asset and what impact it has on funding the project?
We own directly 80%. The other 20% is owned by a company called Mineral and Financial Group, which is a small UK-listed mining fund, I guess would be the best description. We acquired the asset from them through a series of option payments and delivering the initial feasibility study. That's how we earned into the project. There is a potential pathway to 100% ownership. A group called the EDM, which is the Portuguese Mining Authority, has the right to exercise for 15% of the asset, but that would remove 15% of the 20% held by Mineral and Financial. It would have no bearing on our 80% holdings. So if that happens, we see the potential to convert that 15% into, I don't know, a stream or royalty, and then acquire the remaining 5%.
And do you think the government would be accepted?
Well, their mandate is not to fund. Like, they're not going to want to deliver on their capital, their share of capital needs. So we could see them converting it, but they're not going to convert or do any of that until the feasibility study is completed, the permits are in place, because otherwise they have nothing to convert into.
Is this a free carried interest? Any of these interests?
Mineral and Financial is free carry. It would be repaid.
Free carried production or free carried period?
Free carry to production, but they'd have to be. We would be repaid out of cash flow.
So the project has, as you outlined in the presentation, almost 147 million NPV8 based on feasibility study, but this was in 2023. What metal prices were used then, and how do you think the NPV would change if you assume current metal prices?
The biggest changes, to be honest, is going to be gold and silver. I think at the time we used $1,700 gold, probably $20 silver. Obviously, we used more like $2,500 gold and $30 silver, which is probably something in that order of magnitude that will be supported in the upcoming feasibility study. They're going to be a large driver of the value increase. Copper, zinc, and lead haven't really moved on the long-term basis that much, maybe 5 cents here or what have you on the copper side. So, but the real driver is going to be the increase in the precious metals component. We can see that. We can see the value, by the improvements in the metallurgy, the increased resources, changes in throughput. We're targeting something closer to 200 million.
How do you think the Capex and Opex will change in
well, Capex, based on the feedback we're getting to date, subject to change, is actually kind of hanging in around this similar level for the same size facility. Opex in Europe, in this part of Portugal, is actually quite cheap for this type of mining. So it's a very attractive Opex. We actually don't expect those numbers to change much either. Now, on a zinc equivalent basis, they'll probably look lower cost because you're getting better credits.
Yeah, do you expect the metallurgy or flow sheet to change in a significant way?
The metallurgy in terms of recovery and concentrate grades is significantly improved by using better reagent selection, better grind size. We just had the initial feasibility study as part of the option agreement had to be delivered by a certain date. So we had to cut things off. And the optimized study that we're doing now has no restrictions and timelines. So we're able to do better trade-off studies, better optimization than perhaps we could have done in the original feasibility study, just to continue to work on those numbers, which is what we've done.
Feasibility, November or December this year?
That's the target timeline. I don't see could it slip into the new year with the holiday period? It's a possibility, but we don't expect it to.
Essentially then, what remains in terms of permitting, the mine for construction, expected timelines, and what risk you see?
The key things here, obviously completing the feasibility study, which delves into permitting as well. The permitting process, as we press release, we're going through what's called Article 16. In the original feasibility study, we were using cyanide to leach the gold and silver. Through the metallurgical programs that we had done, we completely removed the use of cyanide, which was one of the concerns brought forward in the approval. So whilst we're going through this Article 16, we are just improving those sections where they had an issue, and the primary one was cyanide, which has now been done away with. So we would expect that to be cleared up, call it by November, get that approval. Once the feasibility study is complete, We'll go into Q1 and we'll work with our funding partners for them to finalize their due diligence on the final feasibility study in terms of their technical requirements, and look to sign the funding agreement late Q1, early Q2, and then quickly get into the development phase for Q3.
And when do you expect to announce the funding package?
Well, the funding package is, again, probably sometime Q1.
And how long is the construction period, and what's the expected timeline for fully ramping up production?
Let's call it 18 months of construction, 3 to 6 months of ramp up. So we expect the first ore to be available Q1 of 28. Say by mid 28, we should be at full capacity.
And what does the free cash flow profile look like from Lagoa Salgada?
The first 5, again, we don't have the new numbers, but based on the previous study, we're looking at 75 million of EBITDA per year as a minimum baseline for the first 5 years. I don't see that going the other way, just based on the improved numbers that we're seeing in terms of metal recoverability and payability and price.
And what's the next step for Mont Sorcier, your iron ore project in Quebec?
I would say the key next step, as I said, we're just finishing the infill drill program. That's coming to conclusion, as we've told everyone. Then we'll get into the more engineering side of the study, which will go on into Q1 of next year. I think delivering a very robust feasibility study, really emphasizing the value proposition of this asset. The permitting process in Quebec it can be quite long. What we are seeing a lot of commentary from both federal and provincial governments of accelerating that process. We don't exactly know what that means at this point in time, but we're hoping that will shorten the timeline for permitting. And at that point in time, really the question will be, what does the market want? Does it want us to build it, which is obviously we see a huge value potential there, joint venture it, sell it. We'll look at that in the context of the market, what's best for shareholders.
So how comfortable are you that you would be able to execute on construction of the project if you would go that way?
From a mining perspective, that's probably the easiest mine. It's just bigger equipment, bigger trucks, bigger space. But it's an open pit on surface, very low stripping ratio, and it's magnetite ore. The processing is actually very straightforward. You use magnetic separation, a little bit of flotation. So relative to Lagoa Salgada from a mining and operating standpoint, it's much simpler, much more straightforward. It's just bigger.
Okay, so obviously there will be some paths here, but what do you think will be the most likely and best path to crystallize shareholder value out of Mont Sorcier?
As I said, we're quite comfortable operating it. It depends if you're looking for, if your sole focus is a particular commodity or if your focus is on making money. So if the focus is on making money, we see the way our company is set up now, we can use each asset or pair of assets to fund the next stage of growth. And you can look at it as gold equivalent if you want, or you can just look at it in millions of dollars. We think either way it looks very attractive.
So what are your key capital allocation priorities then?
Right now it's really cleaning up the balance sheet, making sure we're in a good position to support that growth profile going forward. So I think we're well on our way doing that. The capital allocation in the near term, I think we've indicated, we intend to fully move forward with Lagoa. So we'll continue to fund that. We'll continue to fund exploration. And once the feasibility study is completed for Mont Sorcier, the permitting or holding cost is going to be relatively modest. So we'll look at, throughout the construction phase, continuing to build cash from Minera Don Nicolas. And obviously, once we get into the ramp-up phase of Lagoa, continue to build cash there. So we'll be in a position to make that Mont Sorcier decision one way or the other at that point in time, with a strong balance sheet in the background.
Are you currently evaluating M&A opportunities, and if so, what is the target profile?
We're constantly looking at things. I think the market now is definitely shifting to an M&A mode. We're starting to see a lot of transactions, or at least proposals, be them private, smaller assets that aren't being developed by the seniors. So we're constantly looking. Obviously, with the current gold price, some of the asking prices have significantly increased. So you have to make sure that the value proposition is there, whether you can turn it around, can you expand the resources significantly, or is it already kind of tapped out and where the resources can be. So we're constantly looking, obviously, with the improvement in the share price of late, even though we still think we're undervalued. At least now we can look at it without completely diluting the shareholder base.
So could you summarize the upcoming catalyst for the 12 months?
Sure. I think over the next 12 months, it's actually going to be a significant number of catalysts. And these are kind of the goalposts we have to benchmark ourselves around. So first is sustaining gold production at Minera Don Nicolas. So keeping around that 55,000 ounce per year level, give or take. I think that steady production flow in the background is going to be attractive. Obviously, in the near term, we're expecting the feasibility study at Lagoa Salgada to be delivered, followed by the permitting. Both of those are expected in the latter part of this year. Construction decision sometime Q1, Q2 of next year for Lagoa, and the completion of the funding package, and then commencing construction at that point. We're also going to see the delivery of the feasibility study for Mont Sorcier in the first, called the end of Q1, early Q2 of 2026. And I think that will emphasize the value potential that is there for the company. So the next 12 months is going to be a busy 12 months in terms of deliverability. And at the same time as we have those more, I guess, structured timelines, we'll continue to have exploration going on at Minera Don Nicolas and continue to roll out those results as appropriate. But I think that will give the market confidence that on paper, yes, we only have 2.5 years, but in reality, we'll just continue to roll that going forward and continue to produce.
Fantastic. So then with that, where do you envision Cerrado Gold in 2 years from now?
Well, 2 years from now, let's say 2.5 years, we should be continuing to operate at Minera Don Nicolas. We should be in the early phases of ramping up Lagoa Salgada and growing our production profile, whilst continuing to move the Mont Sorcier project forward to some sort of development type decision one way or the other. And I think that's going to be the attractive point. As you continue to deliver these projects, you can see how the building block approach can be used while minimizing dilution. Obviously there's probably going to be some need for equity, but it's not going to be hundreds of millions of dollars and significant dilution. But I think with those assets, we'll start to see ourselves being significantly re-rated in the market relative to our current valuation.